Welcome to The Interest. I'm Sarah Wolak. Happy first Monday of December. Today we'll heat things up with a fiery cage match between our own Vincent Valvo and Andrew Berman. We'll also hear from our analyst Bill Bodnar about what's to come for the last month of 2023. We'll have more on those coming up. And speaking of 2023, it was a big year for artificial intelligence, especially with the release of ChatGPT at the tail end of 2022. This year is when the application picked up, leaving many worried about being replaced by a robot. I had the chance to sit down with a few people in the industry about whether ChatGPT is an asset or direct competition. Let's take a look.
I believe that it will be a mistake if people do not embrace this and learn how to use it, because it does give you a decided advantage.
OpenAI's ChatGPT took the internet by storm at the tail end of last year, and it didn't take long for it to hit the mortgage industry. Companies like Big Purple Dot even incorporated ChatGPT into their CRM ecosystem.
I'm using it constantly. I have it open for everything I'm doing right now.
David Licken says that he uses ChatGPT for his business transformational mortgage solutions. But he says that in order for LOs to get the most out of the application, they need to be asking ChatGPT the right questions.
These are the attributes of an ARM loan. I don't have a lot of experience. What am I missing? And it'll bring you all this data.
One looming concern is whether the program will take over the role of an originator. Licken says for starters, ChatGPT is lacking in its data.
The only thing that would be a detriment is if you're using data that from 2021 or earlier, and things have changed in 2022 and 2023.
Licken describes himself as pro-innovation, but he doesn't foresee LOs being replaced altogether. He also says that robots can't replace the relational component in a loan transaction.
It's going to be a while before a computer replaces Sarah, you and I talking.
To read more about why robots can't relate, go to nmpmag.com. Reporting for The Interest, I'm Sarah Wolak.
Angel AI is revolutionizing the home financing process. Here to tell us about it is Pavan Agarwal, the CEO of Celigence, the company behind this new amazing app. Tell us how Angel AI is helping the home financing process.
We use empathetic AI technology so Angel AI understands the emotions behind human inputs so that the application to approval to close of a mortgage is nearly free of human touch and free of human error and is lightning fast compared to the manual standards of the real estate industry today.
What about the people who have found it hard to get the mortgage?
Angel AI has made the approval process for mortgages fair and transparent, such that we have cut the decline rates for minority communities by half relative to the national average. Just go to angelai.com or click the Ask Angel AI Now button and ask Angel AI your home finance questions, or simply ask her to send you one of these cool free t-shirts. Angel AI has transferred the home financing business and made it fairer and easier for everyone.
Hello, everybody. Thanks for tuning in to our Master the Market segment. So last month was just absolutely incredible. How incredible? It was the best month for bond market and interest rates in 40 years. So it was remarkable. And because of some of the light news that's come in, lower inflation, some of the economic readings, it looks like the Fed's done raising rates. So what does that mean? Well, it means that the last rate hike was in July. And if you look at the last 4 rate hiking cycles, 8.6 months after the last rate hike comes the cut. So that means go to July. We're staring at maybe a rate cut as soon as April on average in history. That's pretty darn cool. So the sentiment has absolutely changed for us in setting us up for a great 24. But we're not out of the woods yet. Still a lot of debt being printed. We're going to have to deal with some auctions this week. And then, of course, this week is also big with the labor market readings. We have ADP on Wednesday. We have the JOLTS, which is, how many jobs are available, how many quits there are, but it all culminates on next Friday's labor market report, the employment report. And if that employment report is indeed an unemployment report, right? We see unemployment go to 4% or higher. Bonds could blast off another level in price and another decline in yield. So it's a good story. I hope this finds you well. Have yourself a great week, and we'll talk to you soon. Bye for now.
Okay, so Vince, I was just reading an article that talked about how the net worth of homeowners is significantly higher than the net worth of renters. Yeah. I know you take issue with that. So talk to us a little bit about why you're against Because actually, we're about home ownership. Our audience promotes home ownership. So please do your best in not to offend our audience.
Well, listen, people who own a house tend to act more responsibly financially. Okay. I agree with that. And so maybe that leads to net worth. But
take that one.
My argument is, and always has been, that it is actually more financially prudent for people not to own a house, not to have a mortgage.
Okay. Why?
And to be a renter. And I'm glad that people do take mortgages and do have this. It gives them a psychological, it gives them high. It gives them confidence, which is why they do stuff. But look, when you take out a mortgage, when you buy a house, for one thing, you had to put a bunch of money down as a down payment, or you pay the whole thing in cash, one way or another. But you're tying up cash. Yeah. You're going to take and you're going to have to pay the taxes.
Opportunity in that.
You're going to have to pay for the insurance. You're going to have to pay for all of the utilities. You have to pay for all of the repairs, and you have to do this every year. It all adds up. If you're a renter, yeah, sure, your rental fee may be more than your mortgage is, but you didn't pay a down payment on your apartment. You're going to be able to take that money and you can invest it. You can have housing and invest the money, and you'll be better off in the long run than you are when you buy the house. Because anybody who is in the mortgage industry takes a look and you say, let's look at that amortization schedule, and guess what? You didn't get a mortgage for $300,000. Okay. By the time you pay this thing off, it's $550,000.
Do you know consumers? They're going to take actually that extra money that they have saved, and instead of investing it and listening to a financial planner, they're going to get cruises. They're going to buy trips to a.
You are right. You're right.
They're going to buy new cars.
You're right. But the argument then is we need better financial education of consumers. Not we just need to shove more home ownership at them.
Education is not going to overcome habits and that good feeling that they get actually when they.
What you're saying is they ought to spend hundreds of thousands of dollars extra out of their pocket over the course of time so that they can feel good. You're a drug dealer.
Because
you're suggesting being a drug dealer.
Builder.
No, you're a drug dealer is what you are.
It's better for our communities. It's better.
It's not bad for our communities, but responsible renters are not bad for our communities too. You want to try an urban area. New York, they got a lot of renters in New York. It's not a bad spot to be. You should try it. I think I'm going to declare victory on this.
Wait, you're kind of out of comparing Manhattan? How's that actually going to this?
For more on these and all of today's top stories, go to nationalmortgageprofessional.com.